This episode of the Australian Investors Podcast is sponsored by Invesco, and it features Andrew Hall, the lead fund manager of the Invesco Wholesale Global Opportunities Fund. In this conversation, Andy and I speak about process, in particular what it takes to invest on a global stage. We talk about portfolio construction, the investment philosophy, and how that distills down into the process that Invesco follows to find compounding businesses and also businesses that are capable of significant improvement. I hope you enjoy this episode of the Australian Investors Podcast featuring Andrew Hall. Andy, welcome to the show.
Thanks, Owen. Thanks for having me.
Traveled a long way just for this podcast, I hear.
Yeah, I'm a fearful flyer, so it's been a long journey.
That's great, mate. We're going to be talking about global equities. We're going to be talking about lessons learned, portfolio construction, and so much more. Reading through some of the literature, actually, there's an interesting place I wanted to start, and that's this kind of definition around portfolio construction, if I may, which is 80% compounders, 20% improvers. And I'm just hoping to start at this point because I think this is a really unique take on portfolio construction and just how you pull apart businesses. So let's just start with that at a high level. What is it? Like, what is that framework? Why does it make sense? How do things fall into each category? Like, feel free to take your time.
So at a high level, what is the point of owning equities, shares in companies? And the real attraction to me of equities is their long-term compounding power. They've been the best asset class to own over many decades. And the reason they've been such a good asset class for owners is because of the capacity for businesses to reinvest excess cash flows. And the best businesses reinvest those cash flows at high rates of return. And ultimately, it's that ability to reinvest, whether it be in a new manufacturing facility or a new truck, or to acquire another company. The most intelligent managers of companies are able to reinvest at high rates of return. And if you can sustain that, you end up with a very nice compounded return over time. So in short, that compounder definition is really about getting to the root, if you like, of what drives long-term returns. And it's really about aligning with those best businesses run by trusted managers that can reinvest capital at good rates of returns.
That's really interesting. So that would be the compounding category. What's this category, the improvers?
So roughly speaking, we say that 80% of the portfolio over time will be invested in those traditional compounders, but we reserve the right to invest the other 20% in what we call improvers. And with the improvers, we're looking for two distinct areas of improvement. The first one is a company that's going through change. So it could be a new leadership team. It could be a business that's being restructured. An example of that today would be Unilever, which we own in the portfolio. Or it could be an industry that's going through a change that we believe is going to drive improved return on capital in the future. And so an example of that would be Ryanair, where coming out of COVID, we felt that the strain that was placed on the balance sheet of the industry would really give Ryanair a once-in-a-generation opportunity to capitalise on the weakness of competitors. And we saw evidence of that with its negotiation with Boeing. And it went to several airports across Europe and renegotiated more favourable terms. So that's an example of an industry going through an improvement phase that's going to lead to higher rates of return for owners in the future. And the benefit of blending the improvers with the compounders is the improvers tend to do something a bit different. They're quite idiosyncratic. That is to say that they're quite unique. They tend to be driven by their own individual change. And so from a portfolio construction perspective, I find them quite helpful in giving us that diversification that might otherwise be hard to achieve.
So you can still have the equity exposure, but in a somewhat uncorrelated or less correlated way.
Precisely.
Yeah. Why is it 80-20 and not 50-50 or some other combination?
So what we've found over time, and as a team, we try and be quite introspective. We have an offsite every year where we'll go away and we'll look at the data in terms of our performance, but also in terms of our decision making. And what we found over the last 10 or 12 years we've been working together is that the improvers, while they can be, real value add, the hit rate on the improvers, that is to say the number of times we're right versus the number of times we're wrong tends to be lower than our hit rate on the compounders. And so that's one of the reasons why we limit the total amount of capital to the improvers. And it's also a reason why we limit the individual position size on the improvers, because the hit rate historically has been lower. And I think the other point I'd say is the range of outcomes on the improvers tends to be wider than the range of outcomes on the compounders. And so just from a simple risk management perspective, the empirical evidence from the past would suggest we should be careful and considerate in terms of how much capital we allocate to those. And I think the other thing I'd say is we're pretty strict. If we see any evidence of thesis drift or thesis break, we're pretty quick to lance those improvers if they're not playing out as expected.
That's fascinating. I love that you harvest that data, you analyze it, even if it's not necessarily an optimal outcome in terms of the investment success and the merits of that, but you still have that kind of discipline to cut, but also to allocate at the same time. I think that's really, really unique. I know a lot of managers that are more than happy not to talk about improvements that they've made or different changes in their portfolio through time, and I think that's a really interesting one. We'll come back to the introspection in a moment, but you've been doing this for a long time. You've been investing globally for quite some time. I'm curious to ask if you could cast your mind back to moments in the past where there was a lot of uncertainty, far more than today. What would be some of the lessons that you've taken from those times in your career?
Yeah, in some ways, I'm the child of a bear market. I mean, I started at UBS back in October 2000, which was, pretty well just as the TMT bubble was peaking. And then obviously we had the 9/11, the tragic circumstances around that, plus the bear market that went with it. And then obviously lived through the GFC. In fact, worked in a bank that was very much front and center, Merrill Lynch at the time, which was rescued by Bank of America while I worked there. And then I guess more recently it was the COVID crisis. And that was a particularly challenging time for me personally and for the team. I inherited the lead management of this strategy in January 2020 and went about restructuring the portfolio to fit, my philosophy. And obviously, the market conditions were incredibly challenging. And I think the key challenge was frankly that there was no analog in the past. There was not an episode in the past where you could go back to and say, well, this is what happened then, and maybe this is how we'd form a judgment on what happens next. I mean, the world got locked down. We were obviously working from home. Kids were being homeschooled. So the personal and professional challenges at that time were really hard to deal with. And from a performance standpoint, we actually lost 9% relative to the market in the first 3 months of my stewardship of the strategy. So sort of having waited 20 years for the opportunity to run a fund, I suddenly found myself, behind the 8 ball before I'd even had a chance to blink. So I'd say that's probably the most pertinent on my mind, at least in terms of challenging market conditions to operate in. And then from there, having to figure out, how do we judge on the success of a vaccine? When might a vaccine come? Will we be allowed out again ever? But of course, the uncertainty created opportunities. And with the benefit of hindsight, and luckily we did take some opportunities, we were able to buy some wonderful businesses at attractive prices, things like American Express, JP Morgan, Ryanair. And as uncertainty sort of went away, the vaccine came back, and there was more certainty in the world. So the valuations of those good businesses began to re-rate.
I love that story. I'm curious if I could double click for a moment. Do you remember, if you remember back, so when you looked at the numbers and you were down 9%, right? Maybe it's not that moment, but maybe it's sometime around then. Was it a matter of taking stock and being like, trying to maintain the perspective that we've got these good businesses, one by one, let's go through them? Like, was there a process that you followed in terms of like the team? Like, was it, how much cash do these businesses have? Like, let's stress test the balance sheet. Like, if there's anything there, I'd be curious to hear what was kind of the playbook.
Yeah, so I'd say there's some personal things and there's some professional things. If I take the personal things first, I remember sometime in March 2020 on going into work, and I was feeling very anxious. My personality, I tend to worry quite a lot, which is sometimes helpful in this business, but sometimes unhelpful. And I do remember at the time thinking, well, look, you're staring failure in the face. And I think I had a sort of an inner moment where I kind of thought, well, look, chances are you could fail here. So if you're going to fail, at least fail doing what you believe. And so there was a moment where it really galvanized me to think, right, if we're going to fail, let's just do this our way. And it really gave me an inner confidence to go away and buy the businesses I really believed in. So that was the kind of the personal side of it. And I think from a sort of personal development perspective, I really feel like that was actually, although it was an awful experience, delivering negative alpha to that extent so quickly, I think it gave me a degree of strength. And so in conditions like we have today, which are also quite challenging, knowing what Donald Trump's going to say next on tariffs or Elon Musk's going to do with Doge, that experience I think has made me stronger. From a professional standpoint, as a team, I think we really came together. The support that I had from Joe, Steve and Emily, John and the rest of the team, I really think what doesn't kill you makes you stronger. So it was a really defining moment for our team, and thinking of each other as partners, we came through it together. And then on a stock perspective, it was about just doing one thing at a time and doing it carefully and doing it diligently. And so there were some decisions that we had to make. So we owned a position in Rolls-Royce in Q1 2020. It's a business that we've done a lot of work on. We were very close to it. We were very invested, if you like. I think we would call it now endowment bias. Yep. So you've done loads of work on something. It's really hard to change your view. But I remember speaking to the CEO of Rolls-Royce at the time, and it was in the darkest days of Q1 2020, and we were going through some of the stress test assumptions, the balance sheet, and I had to make a decision. And my instinct was that we'd got the investment thesis wrong, and this environment of shutdown could potentially impair the balance sheet. And so I decided, with the support of the team, to cut the position. And it felt like a really, really hard decision at the time. But we did that sort of one decision at a time. And while we cut Rolls-Royce, we decided, on the other hand, well, look, that gives us the capacity now, because we've taken some risk off in one area. We can increase the bet size on an American Express or a Ryanair. And so we just try to make one decision at a time, think carefully, be as objective as we possibly can. You're always operating in a situation of uncertainty, so you just try and make the best judgment you can. And that's the approach we're using today in this kind of uncertain environment around Donald Trump.
It's a wonderful answer, by the way. And I like that you took it from both perspectives. And I remember during the depths of COVID speaking to an investor that was quite significantly my senior, and just asking him a similar type of question. And he said something quite similar to what you just relayed about the different positions is, well, let's take it one step at a time. Do these businesses have enough cash to get through the next 2 or 3 years? Yes? Okay, well, that's the first base. Then what's the second? What's the third? What's the fourth? And just, it was one decision at a time. And I think that's a really elegant way to put it. So thank you. Usually when we have people on the show, what we do is we break down each step of the investment process. We might even start at the philosophy and then step through each moment. But as a global investor, you obviously have a very broad universe. So I'm happy to take this whatever way you like. You've already mentioned the broad principle of investing in the equity market. But if you could kind of distill down some of the major points of the process, like if I'm a financial advisor listening to this, or a private investor that could allocate to the fund, like what would be the kind of maybe not the cliff notes, because I don't want to take away from anything, but what would be the kind of elevator extended version? And then I'll have some follow-ups, I'm sure.
Yeah. So in essence, we're looking for three things. And the principle is we want to keep it as simple as possible. We're looking for those superior businesses, so the businesses that have the capacity to out-compound the market through time. We want strong balance sheets for two reasons. One, because if something goes wrong, like COVID, you want a balance sheet that's going to survive. And secondly, having a strong balance sheet gives you optionality. If your industry is going through a period of distress, you want to be the one that's able to make those bets when there's distress, because that's how you add the most value. So the value of a strong balance sheet is really important in our philosophy. And the third thing is we think it's really important to align with trusted managers who have significant skin in the game. And by that, we don't mean egregious option packages which are going to pay out millions of dollars if they make loads of money. We mean if something goes wrong, it'll hit them as hard as if something goes right. So, it may be a founder led business like an Old Dominion. It might be a business with a professional manager, but where there's significant ownership interests, like Simon Burrows at 3i or Jamie Dimon at JP Morgan. So that alignment of interests with us as owners is super important for us. So they're the three defining elements that we're looking for. And in terms of the process, it's a 5-step process, starting with idea generation. And then we try and efficiently prioritize ideas by using something called the determine phase. And that's a simple 10-question checklist, which the analyst will fill out. And then we'll make a decision at that point. Is it worth our time doing a full deep dive, evaluate, build a model, and really stress test our assumptions? Now, we're quite a small team, and so we need to allocate our resourcing as effectively as possible. And so the determine really helps us sift out the things that we're probably not going to own. And then after that, we will approve the decision and finally structure the portfolio, which is basically how do we optimize the portfolio day in and day out. So that's the 5 steps of the process, simply put.
And the acronym is IDEAS. Right?
IDEAS, yeah.
Yeah, I love that. And there's a lot of literature on the website too, which I can link to for people that want to dive deeper. But there was one slide in particular that I saw, and it's basically got 3 columns for people that can imagine this. You can imagine this if you're listening. It's got investment philosophy and might have like some principles, the approach that you take for the portfolio, and then the output, so what you kind of get on the other end. But there was one here which is in the philosophy column. It was align with trusted managers. The approach for the portfolio is who think and act like owners. And then the output of that is high reinvestment rates, high reinvestment rates of return. So you touched on it there. Old Dominion's a very interesting example. We've never spoken about it on the show, which is quite interesting that you bring it up. Can you maybe just talk to us about how you would go about measuring this or assessing this? I know you got high reinvestment rates of return, but a lot of people come on the show and talk about it, this idea to us, but no one ever kind of pulls it apart and explains, well, what are you actually looking for in practice?
Yeah, so again, we try and keep it as simple as possible. Every company that we own, we build our own financial model. And what we don't do is just blindly take the data that Bloomberg has and upload it into a spreadsheet. We go into the 10K or the annual report filings, and we diligently fill in the annual results, going through the revenue, right the way through the P&L, the balance sheet, and then the cash flow statement. And we try and go back as far as possible. Most businesses we cover were around before the GFC, so we try and make sure we capture that down cycle, so we get a sense for how the business behaved in that particular down cycle, although arguably it's one at the more extreme end of what you'd expect going forward. But the thing we do once we've built the model is we then have our own proprietary measure of reinvestment rate of return, which I appreciate is a bit of a mouthful. Essentially, what is the decision-making of management driving in terms of the return you're going to get as an owner? And so with Old Dominion, as an example, Old Dominion is a very capital-intensive business. It's a trucking business in what's called less than truckload. So this is where you have fractional shipments rather than full truck shipments. And one of the key competitive advantages for that business is the location of what they call their cross-docking facilities. So in America, you've got obviously a number of these kind of urban areas, population centers, and obviously you've got all the key highway routes running north, south, and east, west. It's really important in that industry to have strategically located sites. And so Old Dominion, ever since it was founded sort of 80 or 90 years ago by the Condon family, they've been diligently buying these sites. And unlike some of their competitors, they've bought them all freehold. So they're not susceptible to lease cost inflation. And that's been a key advantage as time's gone on. And so what you do in the model is you look at how much capital are they spending and what happens to the cash flow, the operating cash flow as a result of that investment. And so we'll look at the 5-year average investment they've made. Old Dominion's quite a simple business. There's no M&A. It's all CapEx and it's all on property. So you can see how much they're reinvesting. And then you can see what the cash flow is doing as a result of that investment. And over time, you can get a sense check for what the real-time reinvestment rate of that business is. Now, of course, the job for us then is figuring out, is what's happened in the past kind of replicable in the future or not? And that's where the judgment and forecasting the future comes in. And that's why we did a lot of work on, can we continue to trust the management team? Is there opportunity to continue to reinvest? But what that spits out is a number, which effectively we think correlates to the long-term return you can expect from owning the business.
There was actually one question which I was going to ask you. I might ask it now. I might interrupt my flow. And there's a question which is, actually it's from a quote it took it from something you'd written. And you say, predicting the future has never been a fruitful endeavor for us. And this is one thing that investors often struggle with, is that we know it is quite difficult to predict the future, but we want to do the things that you've just laid out or aspire to do them. So how do you square that one?
So I've been getting a lot of questions this week from investors about what I think is going to happen in terms of tariffs, in terms of, how the Doge effects will manifest themselves. And I've tried to be honest with clients that we don't know the future. And it's interesting, if you were to go back to when Trump was elected, there was this very ebullient kind of investor perception. It was going to be taxes down, M&A up, strong, economic growth, great for investing. And so it's interesting, isn't it, that you wind forward 3 or 4 months and now investor perceptions are much more cautious than they were, understandably so. And so I think it's one small reminder that predicting the future can be very, very difficult and quite dangerous. So I always think back to what Charlie Munger used to say, which is always invert. And so what we try and ask ourselves when we're making a decision is kind of what if? And if there's a prevailing consensus in the market, really try and challenge the prevailing consensus, because often the opportunity is in thinking about what isn't priced in and what isn't the consensus view. And so if I go back to Q4, it felt to us as though the opportunity set, particularly within US equities, was much less compelling. We could see that the available returns on the stocks we know and love were going down. Whereas now you've obviously got this environment where there's much more uncertainty. There's a bit more fear about tariffs, what happens to inflation, what happens to economic growth. And we don't know the answer. But if it doesn't turn out to be too bad, then we think there's now some quite attractive returns on offer in our favourite businesses like Old Dominion, like Amphenol. And so we think from a risk-reward perspective, it's become safer to buy some of those things. So I think really it's trying to ask yourself what's embedded in investor expectations and does that feel rational or not? And if not, then it's probably safer to place a bet.
So would you say that then this kind of, the view is you're building that intelligence from the companies you're modeling and the businesses that you're one by one, you're diving in deep, you're trying to get boots on the ground. What's the reinvestment rate potential here? Is that declining, improving? How's the CEO and the management team seeing this? So regardless of the kind of the macro, the top down, you're getting the true kind of underlying value of each business.
Yeah, and I think the key thing is trying to sort of look one step ahead of what the market's currently thinking about. There's normally always something in the market, a point of contention, something that investors are worried about. And I think our job as investors is to sort of isolate where the contention exists and figure out whether or not you want to challenge it or not. So, I mean, I think if you go back to the Chinese tech stocks, for example, they've really been under a cloud now for 2 or 3 years, given much more hostile sort of regulation within China, a more challenged economic backdrop. And of course, I couldn't have predicted that President Xi would be galvanized by the Trump trade war and actually now embraced some of those tech titans in China. And suddenly you've seen a re-rating of those stocks. So it's very hard to predict what or when is going to change. But we knew that Tencent was a winning business run by a founder that we trusted with a net cash balance sheet, reinvesting at high rates of return. And so then it was just a question of being patient and I guess controlling the position size so that if you were wrong, it didn't bury you. And they're the sort of decisions that we're making kind of day in, day out. And I think by aligning yourself with businesses that are superior, normally the world does change in the end, and those superior businesses tend to emerge stronger, especially if they go in with a strong balance sheet.
Yeah, that's a really good point. I see that time and time again. This actually loops us back to something that I did want to cover, which was together with your deputy fund manager, Emily Roberts. I know you spend a lot of time on behavioral finance and bringing that into the investment process and into the team. And I'm always after kind of the practical steps that you take, like how you day to day with your team implement those types of principles. You read the theory of like behavioral economics, behavioral finance, but how do you actually kind of instill that in the team and in your process?
So I think the thing we always try and bear in mind is that as active fundamental managers of other people's money, it is a people business. And although obviously passive has proliferated and has become a much bigger share of total market investments and certainly of day-to-day traded volume, it is still ultimately human psychology that drives the decision making, certainly the marginal decisions that drive share prices. And I think accepting the role of human behavior and psychology in driving share prices is probably the first principle we've tried to embed. The second thing is that as human beings, we are by definition fallible. And so what we try and do is we think about what are our own individual and collective fallibilities. And so by having a team that has different strengths and weaknesses, different biases, and by being really honest with each other about where our vulnerabilities and our biases lie, we can help try and correct that across the team. And we really encourage challenge. So we used to own a position in Roche, and John, who is a really valued colleague, but at the time was one of the more junior members of the team, he wrote an email and basically completely unzipped my investment thesis, and it was a brilliant piece of work, and we sat down and reviewed it as a team, and we made the decision to sell the shares. And so I think having those different perspectives, different ways of thinking, Emily calls it cognitive diversity, we think really helps us come to a better decision. And then there's the practical things. It's how can we try and control the risks of these biases? So you've done a lot of work on a stock, you've really invested time, you've built the model, you've read the 10K, you've met the management team, like you've invested emotionally in that business, you buy it. It's a really big decision emotionally then to change your mind and admit you're wrong and move on. So we've implemented a number of things in the process to try and help us overcome that psychological bias. So in our evaluate templates, we now have a question on the front page, which is, what would cause you to change your view? What would be the thesis breakers, as we call them? And I think by writing them down before you've even made the investment decision, it helps you kind of fast forward to that time when you're going to have to make a decision. It's like, I wrote that, and now I think what I wrote actually has come to pass. And that helps you get over that psychological barrier. And so there's quite a few things we've done in terms of our models and in terms of our templates to try and overcome those psychological barriers.
I like that. And it's almost like starting with the end in mind.
Yeah. Because bear in mind that our hit rate, I mean, we've analysed our hit rate over the last sort of 10 or 12 years, and we think it's pretty good. It's around 60%. But Emily always makes the point that by definition, that means we're going to be wrong 40% of the time. So we better be prepared for that.
Yeah, absolutely. I've actually wanted to ask you about, lessons learned from winners and losers. But there's one question that I did want to double click on. You recently did your 5-year summary of the Invesco Global Opportunities Fund, and you laid out a bunch of different reflections, and it was very succinct. It wasn't that long in terms of the overall document, but one of the lessons that you had there, which was interesting to me, just the title alone was quite interesting, or the heading, I should say. Be careful of death by deception. What does that mean?
Well, often the stocks that make you feel most comfortable are the most dangerous, because you're almost preconditioned to trust it. So the best example I can think of was Nestle. In that really challenging period in early 2020, I felt as though the portfolio balance was too cyclical. And at the time, I was telling you about Rolls-Royce, which we decided to exit. We felt that Nestle could play a really important role for us in the portfolio by bringing more defensiveness. And of course, everyone's got an affinity for Nestle. Kit Kats, Nespresso, and pet food. Yep. And I thought, well, look, this is a really safe business. We spent time talking to analysts, and it felt, really reliable. And the result, if we extend our time frame beyond Q1 2020 and look over the sort of following 2 or 3 years, was anything but that. And what I mean by death by deception is that every time we went to update our model in Nestle, our numbers would go down by 2 or 3%. And it didn't feel like a lot. It was always, it was foreign currency, exchange rate translation, or it was a disposal that we weren't expecting. And there was always a good excuse from the management team, who were pretty slick, to be honest, in terms of how they presented the results. But when we wound forward 2 years, what we found was that our earnings expectations for that business had actually fallen sort of 10 to 12%. And for a business that you bought because it was so reliable and trusted and would deliver in almost any environment, it really surprised me. And so I came up with this sort of idea of death by deception. And Nestle was one of the examples that we now use when we've tried to sort of iterate the process and control for that risk. And so one of the ideas that Joe brought to the table after that was the front sheet. So on the front of every model that we have, every time we update our estimates on a quarterly basis, we have a sheet on the front page, and that tracks our future earnings expectations for the company. Now, obviously, we're never going to be completely accurate on it. Things change, cycles happen, so those estimates move up and down through time. But we really now are very alert to those businesses where you're seeing constant sort of creeping downgrades. And so that's how we've tried to, I guess, mitigate the risk of death by deception.
I like that. It's very easy, isn't it, in a spreadsheet to adjust percentages up or down. And oftentimes you miss a lot of the compounding because you don't see the raw number, what it's doing from one quarter or year to the next. The Invesco website, when I was doing some prep for this meeting, I jumped on, obviously looked at all the key docs and everything. But one of the things was overweight, underweight type positions. And it reminded me of something that a lot of investors probably don't give enough time to, which is this idea that any moment as an active manager, you place a bet, like you mentioned before, selling one position to then, gives you more, dry powder, which you could deploy somewhere else, right? You're taking away from something and pushing it into something else. And I think there was something that you wrote, and I can't remember exactly where it was, but effectively you broadened what you would cover as part of your investing so that you would look at businesses that not only were in the portfolio, but like adjacent to it or in the major indices. And I was curious how you found the impact of that, like broadly. So obviously I was thinking like, oh, cloud computing, like, all these different companies. If you own Microsoft, you might want to be aware of what Amazon's doing or something like that. But I was just curious if that was something that you have any tangible examples from really benefiting either the portfolio, the team, the processes, however you think about it.
Yeah, so the thing we try and bear in mind is that ultimately we are relative investors. We're trying to beat an index. So the fund we run is not an absolute return strategy. So when I took over the fund back in 2020, Emily and I committed to making sure that we covered the largest stocks in the market that had the power to potentially undermine our performance. Mm-hmm. And a number of those large companies, they have good revenue growth, very high margins, lots of opportunities to reinvest at a nice rate of return. They often have strong balance sheets and they're often run by very talented managers. So funnily enough, a lot of them fit the process that we laid out. And so we felt that although there is some viability to the idea that you want to cast the net wide and you want to find lots of Old Dominions and Amphenol's and 3i, you better be aware of what you're competing against, because otherwise, you're taking a risk. And so where we didn't own something that was large enough to in our judgment, hurt performance. So I'm thinking of things like Tesla, Eli Lilly, in the weight loss pharmaceuticals category. We've forced ourselves to make sure that we do the work on those companies. We maintain a model. We update it regularly. And effectively what we do is we treat them as shorts. So we're effectively betting against them. So just as for the 4 years when I was working with Paul Findlay at More Capital, we try and think about those positions as shorts. And we're happy being short, but we better be sure we know why we're short and be prepared to change our mind if the facts change. And so that was really just the mindset change of, let's just make sure we're open-minded about what we don't own. We can't cover everything. We're a relatively small team, but let's just choose our spots, and where there's potential for our returns to be hurt, let's just stay on top of those companies. Hasn't always worked, I must confess.
Yeah. It's no like mean feat. It's a pretty challenging thing to cover so many companies, but to try and push yourself. And like you said before, it's all about allocating the team's resources as well, time, effort, energy, all of those types of things. You did mention kind of lessons learned, and you wrote a 5-year summary effectively around that. One thing that a lot of people say is, they say, oh, well, it's a lesson learned from my mistakes. Right? Not that many people say we try to learn from both successes and from failure. And I think that given the asymmetry of investing, it's almost as if we should spend more time studying our winners, but so many of us are trying, because of loss aversion or whatever, are trying to avoid losing money, as that old Buffett cliche goes. So I'm curious, like, if you have some examples of both of those things. So the successful investments, so to speak, and the kind of losing investments that ultimately you learn from as well.
Yeah. So the way we think about it in our annual offsites is we think about the decisions we make primarily. So was it a good decision? If it was a good decision, why was it a good decision? And vice versa. If it was a bad decision, why was it a bad decision? And what can we learn and improve and iterate the process as a result? So the lesson that I talked about there with Nestle was really valuable in the end, because although it was costly and we lost money for our clients in Nestle, what it helped us do was to understand the mistake, where we went wrong and what the risks were. So when we wind forward to Diageo 2 years later, which we bought, some of the warning signs that we'd experienced with Nestle, we experienced with Diageo as well. And what that forced us to do was think much more deeply about whether or not we needed to reevaluate the thesis on Diageo. And so in the example of Diageo, we bought the shares. 3 months later, they had what looked like an innocuous trading statement, basically saying things are going well, in line with expectations for the full year. And then when I got to the office and spoke to the house broker at Merrill Lynch, he basically downgraded his numbers by a few percent. And again, it looked very innocuous. It was currency, but I decided to call him up and dig into more detail on this. And what I found out from talking to him was that, there was a few concerns about destocking in Latin America. And I just got a sense that this business actually isn't performing quite as well as perhaps the management team were presenting. And so that caused us to do a full reevaluation of Diageo, because we saw some of those similarities with Nestle. And so actually we ended up cutting Diageo, and that was quite a fortunate decision, because in the end the shares ended up falling quite significantly since that decision. So that, I think, is an example of a success. We've had an experience in the past. We've tried to adapt the process to account for that shortcoming in our process, and we've now managed to apply it with some success. And so that's the example I often think about when it comes to sort of learning from our successes as well. In terms of getting things right, I think the combination of owning a really good business that can reinvest at high rates of return, and where the starting valuation is quite appealing. 3i is probably the best example I can think of. Stephen found it initially back in 2020. Joe and Emily supported and did some really high quality research on Action, which is the key asset within 3i. It's a discount retail business based in continental Europe. And the combination of, a fundamentally good business, a long runway for growth, a really talented manager in Simon Burrows, you've had exceptional compounding over the last 5 years. So we're trying, that's the holy grail. If we can keep on finding examples like that, then we'll do well, hopefully.
Yeah, absolutely. There was one question I really wanted to ask you, which I considered to be optional, but I really did want to ask you about it for quite a few reasons. But as far as I'm aware, so correct me if I'm wrong, Andy, your team is not based in London, right? It's outside of London. It looks like I had to Google it, if I'm honest. It looked beautiful. Did you say it was a village? Is that how you describe it?
I'd say a town.
Town, yeah, okay. It looked lovely for what it's worth. And I was curious because there have been so many good investors. If you actually look, I think if you look closely at the origins of a lot of good investors through time, a lot of them are not found in the major, cities and the real kind of what we would consider to be, the meccas for finance, whether it's London, New York, these types of places. A lot of good investors are outside of that. I'm curious how you think that, if in any way, may have impacted you or your team, whether it's process, the way you view the world, just in any way at all.
So Invesco was founded back in the 1970s by Sir Martin Arbib. My understanding is that he lived in Henley-on-Thames, and so it made sense to start the business there. Anyone interested in rowing will know that Henley-on-Thames is one of the sort of meccas for global rowing competitions. So a lot of the top universities in the world come to Henley every year in July to compete. And as you say, it's a very picturesque town. In the countryside, we have a sort of a campus which is located by the river. And so in itself, I'm not sure it means a lot, but day to day, the practical benefit of being based out there, I think is actually quite powerful. So often, I'll go for walks with Emily and John and Elliot and Stephen and others, and we'll talk through the portfolio, we'll talk through the stocks we're working on. And I think just being out there in the fresh air, by the river, watching the world go by at a very slow pace, it just helps you stay in the right frame of mind for making decisions. It's a very stressful job. You're making decisions under uncertainty. And so to be able to walk out of the office and go somewhere like that, I often go for a run at lunchtime, it really gives you that sort of mental freedom to make clearer decisions. And so I don't think there's any perfect place to work, but it seems to work for us. And from a practical standpoint, it means that you can live out in the countryside. I have a 15-minute drive into work in the morning from where I live, and it's a really nice kind of day-to-day life without having to do that sort of horrendous commute into London every day.
Yeah.
So there's a few practical benefits, and there's that kind of distance from the noise, if you like, to help with the day-to-day decision making.
Yeah, I like it. We've had people on the show before and authors, and they've talked about how a lot of the language that we use in finance comes from agriculture and farming. So things like yield, stock, even the stock market, right, where that very phrase comes from, or word, it actually comes from when we used to trade stock or sheep, right? So there are a lot of these things where we don't realize it, but a lot of the roots of investing are kind of, sown in the ground, in fact. And so I think that in itself tells us something about what the nature of long-term investing should be, is to watch it grow through time. I'm going to include links from this episode to the Invesco website, in particular, the fund that you manage and the strategy that you manage. Every time, I was telling the team prior to you coming in today, every time I come across someone from Invesco, I think the standard is set very high. And I'm not just saying that because you're sitting here in front of me. I often think about the variability in terms of people and investors and where they come from. And you think about this in terms of brands, right? In terms of variability and how one thing could be really good and the next thing can be disappointing. Like, say, for example, this Apple computer in front of me. It's a pretty... there's low variability because the brand has a very strong reputation, right? Mm-hmm. And I see that with the Invesco team. Like, literally everyone that's come in has just been really impressive. So there must be something in the water over there. Maybe it's that fresh air, or maybe it's the drive into work that it's appealing to everyone. I'm going to put a link in the show notes to the website, but also to some previous episodes we've done with some of your colleagues. But one of the questions that I always ask anyone that's new on the show is more philosophical in nature. And it is, if you could go back in time and tell a younger you something about finance, money, investing, life even, what would it be?
Well, I guess I've spent the last 20 years listening to Warren Buffett and Charlie Munger give advice. So it's probably going to echo something that they've said. I think it would be, just do your best, work hard, act with integrity, and normally good things will happen. I'm a bit of a saver myself. I do think it is important to save as much as you can, spend less than you earn, in other words.
Yep.
And then let the compounding do the work for you.
Sage advice. Well, mate, I really do appreciate you taking some time on your busy trip. Thanks for stopping by Melbourne and doing this with me.
Thanks for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.